Let's do a renewal scenario. I think this is top of mind because, as you know, tons of people are coming up for renewal, and a lot of people are going to be facing the payment shock. And banks are sending out a renewal notice with a very convenient way to sign. We've spoken to quite a lot of brokers as well as people who work at the bank. They've told us how brokers are winning over the bank's offers, and this is an actual scenario that did. So here we are. New scenario. We're going to do a renewal this time. And by tapping new scenario, I get the option to choose. So what would you like to compare? Renewal or switch? So just like the purchase scenario, it asks you for some details up front because we want to make sure that you're creating an actual scenario for it, not overwriting the previous one. So I give it a name. All right, here we go. Current balance. So this is the client's current balance. It doesn't have to be exactly today. You can actually use a 2024 end of year statement. We actually built support for it specifically so that you can go back in the past and create any scenario that your client is sending you docs for. Betty, for instance, here had a 2.64 or has a 2.64. Her current balance is 400,000. We try to estimate the payments, but it's not exact, of course, because we don't know what's the remaining amortization. But so this one was 21/24/04, and the next payment date is going to be on June 1st. So that's the next payment date, and we're going to go next. Current lender is, let's just pick a lender out of the hat, RBC. The maturity date is key. So this one is actually in a few months, in 3 months. So that's, if we were to go to put the maturity date, it would be August 1st, which makes sense because at the end of the term, you have a 20-year AM. Right now, you have 3 months remaining until the end of the term. Okay. Next. The dates are super important because it helps to make the numbers way more accurate than if you're just guessing if today is the maturity date, then it's obviously a different story than if it's in 3 months. Okay, so now we're presented with customizing 3 options. And what we're doing is the lender is offering Betty a 4.39 fixed. So I'm going to rename this to current lender, because that's going to look nice on the report as well. And they're offering her a 4.39 fixed. And we're going to be offering them 2 options. So we're going to do option number 1. Let's just call this one fixed. We obviously can do a lower rate. So we do a 4.19. And we are going to give her a second option. And this one is going to be an adjustable rate. For example, you're moving her to Scotia and there's an adjustable rate happening. This one is slightly higher, 4.45, but we can change this to a rate type of adjustable compounded monthly. Done. Let's create an initial comparison here and see what's going on. There it is. You can actually see that currently she has a $400,000 balance, 20 years and 3 months left. Her current term is 3 months, 3 months left before the end. And what the app automatically did is it created the current situation on the first term, because that's still active, and then added the renewal option to term 2. So this setup gives you the ability to show very clearly to your clients what happens if we were to switch now or switch after 3 months and what kind of term we want to go into. Let's go into the analysis just to take a quick peek. You'll notice that there is a payment shock. We have 3 months of good times, and then boom, payments increase in all options. So current lender is obviously in the middle here. You can see the blue line. Our adjustable rate has the highest because our rate increased. And in terms of interest, looks pretty much what we expected. So let's go and do something fun, because adjustable is not really adjustable unless you are building some projections. So the ability to do that is built in, but you have to tap on the correct place. So here, for example, I want to edit term 2. I want to edit the option ARM, but in term 2. All I need to do is tap on it. And now I get into more details about this particular term. You can see it's a 5-year, it's an adjustable, it starts with 4.45, and here's our projection that we're going to edit soon, the payment for this term, and then of course the details like the balance, the starting balance, the ending balance, the starting amortization, the ending amortization. And the rate has not changed because we didn't build any projections yet, but let's do that. Let's tap on this and let's add in, let's say there are 3 more decreases in the next 12 months, and then there's another increase happening next year. So all I would do is I just tap on this, do a decrease in December, and maybe another decrease in March, and then another one in July. And then in December, we're going to have an increase. So that's the projection map. You can see here, you get the drops and the increase and what it means to your balance as well, and also your term interest. That's the current term. Let's exit out of this, save this. And now when we go to our analysis, it looks way different because the payments, as you know, adjustable changes payments when prime rates change. So you can clearly see here that my payments decreased. And actually, even though there was an increase next year, my payments are still lower than the current lender's offering. So here's an advantage to Betty. Clearly shows that yes, it's higher now, but as soon as there's even one decrease, you're going to be paying less than what your current lender is offering. And in terms of interest, same thing, your interest drops. And now the adjustable is by far the best options. And exactly how much? Let's go into table. You can see that the interest is $7,000 less than the current lender's offering. So that's a huge saving for her. Now, you can give her some other options. For example, we only carried on the current amortization. Let's go into this guy here, the 5-year fixed. It was 20 years and we kept it. What if I want to update this? I want to extend amortization because that's also going to lower my payment. So to do that, I don't have to overwrite my fixed option. All I do is I duplicate it. And now I have another option called fixed copy. Let me change the name to, let's call this one fixed plus am, because that's what I'm going to do. I'm going to change the amortization. And then in here, in the second term, I'm going to extend amortization to 25 years. I actually wrote it down here. So show advanced, adjust payment and amortization, and let's just extend it to 25 years and 0. So we start with the 25 years right away. And if I want to be a little bit complete, I will add some notes for Betty. For example, extended amortization to 25. So you can add notes to any of the terms that will show up in the report, and of course that will explain things more clearly. So now I can go into the analysis and let's take a look at the graph first. So payments, you can see now the yellow is the fixed plus the extended amortization. The client is no longer experiencing a payment shock because it's very, very on the same line that what they originally had. So that's amazing. That's a good thing here. Interest-wise, yes, it's not the greatest, but also not very far from the original. So let's take a look at the table here. we're comparing current lender and fixed versus this, and you can see, yes, you actually pay a little bit less interest. So that's good. No, actually, this is a winning one at this point. But your balance is going to be higher at the end. Well, no payment shock, less interest. Why not? Another scenario you can do is in the adjustable rate, for example, basically the client says, hey, you know what? I need some equity because maybe Charlie's going to school and I need to take out $17,000. So what we can do for her is we can just duplicate our arm, the adjustable, and let's give this a new name. Let's call it ETO. We're going to do some equity takeout. And again, in term 2, I'm going to tap on this, show advanced features, add equity takeout. Let's take out $17,000. And you will see right away that the balance, the starting balance of this term changed by the $17,000. Save this. You have an indicator for equity takeout in case you forget what you did. So that's pretty handy. And you can even say, Betty, you know what? If you need the money right now, you can break your current term, the 3 months that's left, and switch to this other lender and take out the equity. So you can do that too by just tapping on this area, because that's the 3 months term that we have remaining. Show advanced features, add a breaking event right away. You can set a 0 because that's the time indicator of how far into the term you want to break. We included a feature for you to estimate the 3 months penalty. So just tap on this here and it will tell you what the penalty would be if you were to break today. Save term, and ta-da, you now have a super awesome option where you're breaking the 3 months right away, you're taking out equity, and you're going to an adjustable rate with prime rate projections. How will this look in the report? Let's look at the analysis first. It'll take some time for you to analyze it, but you can see that the last option, the green one, the payments are higher because right away we broke the mortgage or the term and we increased the payment right away, but we took out equity, so it was worth it. And then of course it will write the same prime rate projection that we added into the original adjustable option. Some features actually I want to show you just before we finish with this is inside any of these projection maps, you can copy them. You can copy the projection and you can paste it into another term. You can also share with your colleagues. Say one person on the team creates a projection for the next, God knows, 3 years. You can now all use the same projection across. So that's possible as well. You can give them a name and then copy it and share.